This is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook. I do these videos to help you navigate through all the fear-mongering and all the crazy bias and spin that you hear on the news every day, and just give you the information that you really need that's important for your portfolio. So this month's topic, I'm trying to stay positive because there's a lot of bad stuff going on in the world, as you all know. We did start off with a nice rally at the beginning of the year. We've hit a pretty tough wall here recently. So what is going to keep that rally going? And I'm going to talk about the three things that are happening that have shown some cracks, but I believe are still happening and will support this rally potentially continuing on. Let's get started. All right, as always, we like to get started with the asset class returns. This is for the month of October. Again, the green shows what's going on year to date. The blue shows the month of October. So as you can see, the month of October was not a good month. So now we got two bad months in a row, September and October. Seasonally, these are bad months. November, December do tend to be more positive. So we'll see. There's a lot of earnings that are coming out, a lot of economic data that's coming out that could change things for sure. But what we've seen here, and the main catalyst has been interest rates have been going up. We've seen the Fed got a little bit more hawkish last month, but we're starting to maybe see some light at the end of that. We'll get more into that as we get into the updates. But a couple highlights here. You can see small caps took a pretty good hit. Real estate has been down in the dumps. A lot of that is because yields are high, and of course a lot of the real estate debt that banks have that potentially could be in a little bit of trouble. Internationally, you've had the dollar that's been strong, so that's hurt international. And the fact that internationally, especially in Europe, their economies are slowing down some, so that hasn't been good for them, and that's hurting the performance. And we finally have some negative returns, unfortunately, for fixed income. We had a nice bump up at the beginning of the year, and now we're in the hole a little bit again. A lot of that's because inflation is still kind of high, and it's been going down, but not quick enough. And so that's hurt fixed income as those yields have stayed kind of high. High yield, still positive, but it's off a little bit. And then the last piece is commodities. It's kind of a mixed bag there. You have oil that's actually been down, ironically, with all the geopolitics going on. But gold has been up, so it's kind of a wash there. So we'll get a little bit more into the oil story here in the update as well. So let's jump right in. All right, lately every market update starts with an inflation update because that's what it's all about. That's what's driving the Fed, and the Fed has a huge impact on what the market's doing. So the big news is the PCE report that came out. This is the Fed's favorite number that they look at. It comes out right at the end of the month, so this is pretty recent data. It showed a month-over-month move up of 0.3, which again, if you annualize that, that's 3.6. The actual year-over-year is 3.7, so it's starting to come down. It was in the 3.8. 3.9 range, so it's coming down, but painfully slow. We'd like to get right to 2% right away, but the economy is still showing a lot of resilience, and of course, we still have a lot of service inflation that's still in the system that sometimes can lag, and so it'll be interesting to see what comes out of the CPI report, which is the one that comes out on the 14th. This is the most popular one, so that will be the first one that we'll see for the month of October. So we'll be closely monitoring that. All right, so it's hard to do an update without talking about a little bit of geopolitics. As we all know, there was a horrible attack in Israel by Hamas. And the big concern there is that it would turn into a bigger conflict, which would then affect oil prices. Again, the Middle East is where there's a lot of oil moving around, and it can become a bottleneck, especially if we start to get Iran into this conflict, because they're very close to all the bottlenecks, the Suez Canal and the Strait of Hormuz and all those areas. So that can make oil prices jump. So I wanted to show you this chart here to show you the level of concern that the marketplace has, because it's a little different from what you're hearing in the news. Because I watch the news, and that's almost always what they're talking about, is how this could potentially be a huge regional conflict, which of course it still can be, but at the moment it doesn't seem to be. And here is some proof. This is the price of oil from the weekend after October 7th, since it was on a Saturday. Oil prices are actually down. Down over 6%. Now that was as of the date that I printed this chart on the 1st of November. Actually, I think it was down a little bit again November 2nd and the 3rd when I'm filming this. And so it's going down because the conflict is not escalating. And so right now the market is looking at this conflict obviously as a horrible event, but it doesn't seem to be escalating into a bigger regional conflict at the moment. So that's good news that we're not seeing this turn into something much worse. Of course, it's early on, and this is probably going to last for a while, so it's something that we're obviously going to be keeping a very close eye on. All right, so we got geopolitics going on, we got inflation going on, but the other big piece of news is what's been going on with our government and our debt. And this notion or this question, is our government debt sustainable? Okay, so I'm going to address this in the next several slides. I thought this was important enough to talk about. The simple answer to this question is, in the long run, no. In the short run, I'm going to show you how it's not as bad as some of the fear mongers out there are making it to be. Okay, so I think things have gotten a little overblown, but is it a big concern? Yes, and it's something to keep an eye on and definitely something to address. Okay, because what you can see here, this is how much debt we're running each year, and you can see through COVID we had massive deficits. And it's gotten a little bit better, but not much better. I mean, we are almost back to normal. You can argue that we are back to normal. And in fact, we have a pretty decent economy at the moment. It's slowing down, but it's still stronger than it was a couple of years ago. And we're still running some massive deficits. This is definitely a problem that we need to take a look at. So the next couple slides here, I want to show you why all this mounting debt is a problem. Okay, so this is a report by the CBO showing how much interest we're paying on our debt. And so right now it's gotten up to the $700 billion amount in interest. And the CBO is actually predicting that in the next 10 years, it could be double of that, about 1.4 trillion. And that's a massive amount of money that's going to be deviated from other things that we would find hopeful and useful, for our country, instead of just going to pay interest. And to put an exclamation point on this idea of the interest on our debt, so you can see right now it makes up a big chunk, and this is as of today's debt, but 10 years from now, it's going to make up an even bigger chunk. It's actually going to be more than our defense spending. It's going to be almost as much as Medicare, and it's going to really start to crowd out other things that we might need to spend money on. And so this is a major long-term problem. All right, so here is the final chart that I want to show you about our U.S. debt and answering the question, is it sustainable? And I think, at least for the moment, it does appear to be sustainable. So these concerns about us not being able to auction out our bonds and issue bonds and get a decent price for them because we just have so much debt is a valid concern, but might be getting a little overblown. As you can see here, the interest on our debt as a percentage of GDP, this is where it's at right here. Now this was a little dated. It's about not quite a year ago. It's probably up a little bit higher now, but it's still much lower than it was back in the 80s and 90s as a percentage of our GDP, because our GDP has been growing a lot as well. And so, of course, when you watch the news or even other YouTube channels, they don't like to point that out because it's not as it's not as exciting, or it's not going to get as many views to say, look, things are on a bad path. We need to go on a better path. We need to have more fiscal restraint. Yes, I agree with all that. But we're not at this point where we can't take care of our debt and we can't issue our bonds. In fact, just this week we had several auctions. The numbers were higher than we've seen in a long time as far as how many bonds we were issuing, but everything was orderly. It got bought up quickly, and we got reasonable interest rates. And so that's one of the reasons why we've been seeing the market start to calm down a little bit, as well as some of the other points that I'm going to bring up here next. All right? All right, so we got off on a bang at the beginning of the year, and over the last couple of months, we've hit a wall. And so what is going to make this correction stop? Well, I think we need to remember why the market was rallying to begin with. And so I'm going to simplify this into 3 basic pillars, okay? And so these are the pillars of why we have been rallying in the first place. And if these 3 pillars continue, we will continue to rally. And I'll go through each one of these real quick. So number 1, the Fed hints that they are done raising rates. Well, they did pause last month, and then, of course, I'm sneaking in a little bit of November news into the October report because it happened on November 1st. The Fed, just on Wednesday, decided to pause again, and then reading between the lines, they seem to be a little less hawkish than they were last time, almost like raising the bar for raising interest rates. And so that seems to be holding up, that the Fed may be done raising rates, if not super, super close. All right, so check mark on that one. Number 2, Goldilocks economic numbers. Well, we've had several reports over the last month that shows the economy is slowing down. But what needs to happen is it needs to slow down so that inflation would come down, but not too much, okay? And we don't want hot numbers either, because hot numbers means more inflation, and the Fed is going to start getting more aggressive again. And so what's been happening? The manufacturing report that came out last week actually showed some weakness. It was showing below that 50% number, and so that shows contraction, and it was actually a little bit worse than we were expecting. So that shows a slowdown. But then, just today, we got the services number that showed above 50, so that shows expansion. But again, coming down. So we have pretty much what I would call a Goldilocks economic situation. The other piece that came out was the employment numbers on Friday came out, and we had decent employment. It was like 150,000 new entrants into our economy. They got jobs. Now that number was lower than expected, and it was a lot lower than it was last month. So again, what we're seeing is Goldilocks. Not too hot, not too cold, and the wage numbers, wage growth was also a little bit slower than last month. So the Fed is kind of getting all the things that they want from the economic numbers. And so that should help with number 3, which is inflation continues to go down. We're seeing that happen. It's coming down slowly like we talked about in the update, but it does seem to be happening. But of course, that's something that we need to continuously monitor. But every time there's news that shows not too hot, not too cold, it's going to be good for the market. Anytime we see news about inflation going down, that's going to be good for the market. Every time the Fed pauses again, that's going to be good for the market. The opposite could be bad. We actually could slow down too much. And that is actually, for me, a little bit more of a concern than the economy getting too hot. All right? So the 3 pillars. Remember that as we look at what's going on. All right, so here are the Heartwood implications. So we are going to stay on the neutral path. So that's right down the middle lane, not more aggressive, not more conservative. And we're doing rebalancing right now as we sell stocks and buy bonds, although we haven't done that as much in the last month because the stock market has been down. But every opportunity that we get, we will continue to do that. We have seen a nice move in the markets here in the first week of November. I normally don't throw that in, but it's been a pretty sizable move. And that's because the 3 pillars that we talked about a moment ago are holding up very well. But we will continue to add more to the large cap and quality, reducing small cap and international, because I still think there's a pretty good risk that the Goldilocks economy can turn into too slow of an economy. And so that risk is still there. But I think there's a win-win for bonds. If we get the 3 pillars, the bonds are going to do well. And if we go from Goldilocks to a little slower economy, the bonds will do well too there. So we're going to continue to add to bonds, continue to add to duration to lock in these great yields by lowering our cash. So I hope this was helpful, guys. Thanks for watching. Please feel free to share with your friends, family, colleagues. And as always, God bless.